Cash-on-cash return, the investor's North Star in commercial real estate. Commercial real estate has long been hailed as a wealth-building avenue, promising substantial returns for those who invest wisely. But amidst the flurry of metrics, calculations, and projections, there's one figure that stands as the true north for real estate investors: the cash-on-cash return, COC. While cap rate offers valuable insights, COC is the ultimate measure of an investment's immediate cash flow and profitability. In this in-depth guide, we'll unravel the significance of COC, differentiate it from the cap rate, and equip you with the knowledge to assess your real estate investments like a seasoned pro. Section 1. Key metrics in commercial real estate, the dynamic duo. Before we dive into the intricacies of COC, let's revisit two fundamental metrics that every real estate investor should know. Cap rate, capitalization rate. Definition: cap rate is the ratio between a property's net operating income, NOI, and its current market value or purchase price. Calculation: cap rate equals net operating income, purchase price. Significance: cap rate offers a snapshot of a property's potential profitability in relation to its value. It's a long-term metric used to compare different investment opportunities and assess their overall return potential. Cash-on-cash return, COC. Definition: COC is a measure of the annual pre-tax cash flow generated by a property relative to the total amount of cash invested. Calculation: COC equals annual pre-tax cash flow, total cash invested. Significance: COC focuses on the actual cash an investor receives from a property after all expenses, including debt service. It's a crucial metric for investors who rely on financing and need to assess their immediate returns. Section 2. Why cash-on-cash return is your most important metric. While both cap rate and COC are important, COC holds a unique advantage for investors. Focus on actual cash flow. Unlike cap rate, which provides a hypothetical return based on market value, COC tells you the actual cash you're pocketing. This is invaluable information for investors who need to see immediate returns on their investment. Investor perspective. COC speaks directly to an investor's bottom line. It answers the critical question: how much cash will I actually make from this investment each year? This clarity is especially important for those who rely on real estate income for their livelihood. Comparison with cap rate. Long-term versus short-term cap rate is a long-term metric that helps you gauge the potential for appreciation and overall value. COC, on the other hand, focuses on short-term cash flow, which is essential for managing expenses and generating income. Risk assessment. COC is a valuable tool for assessing risk. A low COC might indicate that the property has high operating costs or is over-leveraged, posing a higher risk for the investor. Financing impact. Leveraged investments. For investments that involve financing, COC is a more accurate measure of return. It takes into account the debt service payments, providing a realistic picture of the actual cash flow. Return on equity. COC helps you understand your return on the actual equity you've invested, rather than the total property value. This is crucial for assessing the efficiency of your investment strategy. Section 3. Calculating cash-on-cash return, a step-by-step guide. To calculate COC, you'll need the following information. Total cash investment. This includes the down payment, closing costs, and any upfront renovation or repair expenses. Annual pre-tax cash flow. This is the income remaining after all operating expenses and debt service have been deducted from the property's gross income. The formula is simple. COC annual pre-tax cash flow, total cash investment. Interpreting the results. The resulting COC is expressed as a percentage. A higher percentage indicates a greater cash return on your investment. What constitutes a good COC varies depending on individual goals and risk tolerance, but generally investors aim for a COC of 8% or higher. Section 4. Practical applications of cash-on-cash return. Let's look at a couple of examples. Example 1. A property with a high COC, 12%, might be located in an emerging market with strong rental demand and lower initial investment costs. This could be a good investment for those seeking higher returns but comfortable with the associated risks. Example 2. A property with a low COC, 4%, might be located in a prime location with high property values and stable rents. While it might offer lower immediate returns, it could be a safer investment with the potential for long-term appreciation. Investment strategy. COC can help you tailor your investment strategy to your specific goals. If you're seeking immediate cash flow, you might prioritize properties with higher COC. If you're looking for long-term wealth building, you might focus on properties with lower COC but with the potential for higher appreciation. Portfolio diversification. KOC can also be a helpful tool for diversifying your portfolio. By including properties with varying KOC rates, you can balance risk and return, potentially mitigating losses during market downturns. Section 5. Integrating cap rate and cash-on-cash return. While TOC is the ultimate measure of immediate cash flow, it's important to remember that it's just one piece of the puzzle. A holistic approach to real estate investing involves considering both cap rate and COC, along with other factors like market trends and property condition. Optimizing investments. By carefully analyzing both metrics, you can identify opportunities that offer a balance of immediate cash flow and long-term value. For instance, you might invest in a property with a moderate COC and a favorable cap rate, ensuring both short-term income and long-term growth potential. Long-term planning. Integrating both metrics into your long-term planning is essential for sustained success in commercial real estate investing. By regularly evaluating your portfolio's COC and cap rate, you can make informed decisions about when to buy, sell, or hold properties, maximizing your returns over time. Conclusion. Cash-on-cash return is a powerful metric that can illuminate your path to financial success in commercial real estate. By understanding its significance, calculating it accurately, and integrating it into your investment strategy, you'll be well equipped to navigate the complexities of the market and make informed decisions that lead to profitable outcomes. Additional resources. Explore online calculators for cap rate and KOC. Seek out books, articles, and courses on commercial real estate investing. Consult with experienced real estate investment advisors or financial planners for personalized guidance. Remember, knowledge is power in the world of real estate investing. By mastering the concepts of cap rate and COC, you'll gain a competitive edge and unlock the full potential of your investments.